coming back to my channel. I am Chelsie Runnings, a residential real estate expert in Sonoma, and today I have Dan Ancheta with Synergy One Lending. He is a loan officer and just a loan guru. He's my go-to guy for sending my buyers out to get home loans. So Dan's jumping on with us today to talk a little bit about different types of loans. I've been getting tons of questions from people about loans and what might be best for them. So Dan, thanks for jumping on with us.
Absolutely. Thanks for having me. Thanks for welcoming me to your channel.
Yeah, awesome.
We love your videos, by the way.
Oh, thank you. That makes me happy. So my first question is, when people are ready to jump into getting into real estate and wanting to make a purchase, what should they expect to have ready for taking out a home loan?
Yeah, for sure. So as you know, the very first step is to get pre-approved for a mortgage so that when you go house shopping, you know what you can actually afford, so you don't fall in love with a house that you actually can't buy. So step one is to talk to a lender who can help you with that process. And the typical things that we need, depending on the type of borrower and their income, is things like tax returns, bank statements, W-2s, pay stubs. And I'll actually give you a list that you can either post in the notes or add to the video that we can show people. And if you're self-employed, we need your business tax information, a profit and loss statement, the business bank statements, and a few other things. If you are on Social Security, we'll need the award letter, or if you have a pension, need the award letter. There's a specific list for every individual borrower depending on how they derive their income. And if they own other properties, then we'll also need mortgage statements and insurance declarations pages for each of those properties, so we can accurately calculate the ratios and make sure that we're qualifying them fully. I'm not a back of the napkin qualifier. I like to make sure that we've got everything in line so that there's no surprises down the way. So my philosophy really is to collect more upfront, so that we have a smoother process when they get into contract, and we're not asking for things that we should have received weeks or months ahead of time. So I always get the question of, is it too early for me to get pre-approved? There's no way to be too early. And I have buyers I've worked with for years that have not bought a house, but we talked 2 years ago to get them pre-approved, and they still haven't found the right house, but they know what they can afford, and that's okay. We have lots of conversations.
So for people who are keeping records, how long should they be keeping records? Like, do they need 1 year, 2 year? How many years worth of tax records and employment records do they need?
Typically, we're looking for 2 years tax returns and W-2s, and the last 30 days of pay stubs, and 2 months of asset statements. So that's checking accounts, savings accounts, investment accounts, 2 months of those.
Okay, and then there's a huge no-no. Like, when you do get pre-approved and you are in escrow, there is a massive no-no that you need to tell your buyers. What is that?
Well, there's a few, but number one is don't quit your job. Which one are you talking about?
I'm talking about, like, don't go out and buy like all new furniture on your credit card, or don't go and buy a car.
Yes, I've had funny anecdotes. So I've had a borrower, like, at the closing table go, by the way, I co-signed on my son's car yesterday. And I'm like, you did what? Fortunately, it worked out okay. The ratio still worked, but we actually had to go and get a copy of that note, add it to the debt ratio, and make sure that the deal still worked. If her ratios are any tighter, it would have not. We would have had to cancel that deal. That would have been terrible. So yes, don't go spend money on your credit cards. I always tell people, when you're buying a house, you're in contract. Of course, you need to get PG&E transferred to your name. You got to set up the water bill. You got to get Comcast. You got to do all those things. Totally, that's fine. But don't go, like you said, go get a brand new credit card to buy stuff at Home Depot. Don't do that. It can wait. Just give it a week. Let me close, and then after we're closed, do your thing.
Cool. So I've been getting phone calls and emails. I think people have been seeing my real estate videos, and they're hearing me talk about the real estate market and these low interest rates. So people are reaching out and asking me, like, should I do an FHA loan, or should I get a different loan? So let's start out with FHA loans. What are the pros and cons of FHA loans?
Yeah, totally. The FHA loans exist to help people who wouldn't otherwise qualify in conventional financing to get a government-backed loans, because The U.S. government has decided that it's a priority for citizens to be homeowners. There's tax incentives to be a homeowner. There are reasons, like good reasons to own homes, and so the U.S. government has created the FHA program to help buyers buy. So the good thing is, as a low down payment, 3.5% minimum, typical, and the guidelines to qualify are much more to the home buyer's advantage. So there are things that happen in conventional loans that, such as like the Fannie Mae, Freddie Mac loans, that preclude some buyers from being able to complete a transaction. And the FHA is much more liberal with those things. So you can have a higher debt to income ratio on FHA because it's backed by an insurance policy that guarantees the lender won't lose money, basically. So that's the good part. The downside with FHA is that there's upfront mortgage insurance called MIP, mortgage insurance premium, that's added to the loan amount. So depending on your purchase price and loan amount, it can be $10,000 of additional principal that you wind up having to pay that you don't ever get to get rid of. It just kind of adds it to the loan amount for the upfront mortgage insurance premium, in addition to monthly mortgage insurance. So that can wind up being very expensive. But because it's a subsidized loan, the interest rates are typically very aggressive and lower than conventional because of that kind of lack of risk for the investor. So good things are low interest rate. Good things are relatively easier to qualify, higher debt to income ratios. Those are all the good. The bad side is I think it winds up being a pretty expensive loan in the long run.
So if you have a solid credit score and a solid job, but you don't really want to do a 20% down payment, you can get another loan for that.
Yeah, so there are a number of ways to tackle that. So I think a big some misinformation out there is that if you want to buy a house, you have to have 20% down. And I'm in Sonoma County, you're in Sonoma County. Median home price is what, 700,000. 20% down is a lot of money, and most people don't have 20% down to make a first home purchase. So there's a number of ways to tackle that. You can go FHA 3.5% down, and you can go to the high balance limit of the county. So because of there's different high cost of living areas, there are different loan limits depending on which county you're in. Sonoma County is about 705, just under 705,000. Marin, San Francisco is higher than that, it's like 765. If you're in Sacramento or Lake County or somewhere like that, it's the $510,000 loan limit. So depending on your purchase price, you can either go FHA 3.5% down, you can go conventional with 3 or 5% down minimum, depending on your loan amount. And those have mortgage insurance. You can also do a 10% down with mortgage insurance, or 10% down with a home equity line of credit for purchase money. So you do basically like an 80% first, a 10% second, and 10% of equity down. It's called an 80-10-10, right? And for the viewers, I can map that out for you. And so I say all that, and I know it's a lot of information, but I say all that to say there's lots of options if you're not putting down 20%. So depending on what your individual factors are, you're going to want to get a total cost analysis from your mortgage advisor. And I say total cost analysis and ask for it specifically. The product's called Mortgage Coach. I'm a big fan of Mortgage Coach. If the mortgage advisor that you're working with does not use a total cost analysis, find a new mortgage advisor. It is the best demonstration of comparing apples to apples side by side, what the difference between the program's rates and closing costs are. It's super simple. I'll send you a template that you can include. That'll just be a generic look at it. So I think the important thing is that this is where the team that you work with, your financing team, your realtor, et cetera, your insurance person, does really truly matter. So find those resources, get connected, and make sure that you're getting sound advice. There are lots of people out there that will give you a home loan, and very few that take the time to explain the financial implications of making a home purchase. So make sure that you fully understand what the loan's going to cost you up front, what the monthly cost is, and that you have a financing strategy in place to manage the debt. I'm a professional debt manager. We're going to help you buy a home for sure, but also I'm going to give you the biggest debt you'll ever have in your life, and it's my responsibility to help you manage that. So if you're just getting a loan estimate, that's not good enough anymore. Get a total cost analysis. There's my plug for Mortgage Coach. Hopefully, Dave Savage, if you're watching this, hey. Anyway, so yeah, so I'll send you that you can include in the notes for this the difference between a FICO score of 660 and 740, all else being equal, what that does in a difference in payment between FHA, 3% conventional, 5% down conventional, 20% down conventional. So you can really see a side-by-side comparison of what that looks like. So if someone's wondering, hey, here are the individual factors I have for my loan, what's it going to look like? What's the payment going to look like? What's the down payment going to look like? What's the total cash needed to bring in going to look like? We can quantify that for people early on in the process so that there's no surprises as they go through their home purchasing. I know that we've worked together a bunch. I know that how you work, and I like to say, we do the upfront work ahead of time so that when someone is home shopping, they can just enjoy the process of finding a home, and they can just, take the time to just dream and think of their future instead of worrying about sending me tax returns. I don't want you to be worrying about that when you're, I want you to be focusing on what you're going to do to that home to make it yours. So that's kind of our philosophy.
I think something that's really been helpful for some buyers that I'm working with right now is they had to come up with a slightly higher purchase price, and they were really freaking out that was gonna just they weren't gonna make it. It was like $10,000 or $15,000, and in your head when you're thinking okay, I'm gonna make a purchase of $265,000, and then they come back and they're like 280, and you were approved at 280, but you really wanted to come in at the 265. It's really not that big of a difference. And I think that cost analysis breakdown, and I did a breakdown for my buyers just to show them really what they're going to be looking at in a monthly difference. And it's even though the overall purchase price came up to $15,000 difference, the monthly really broke down to $60 difference or something like that. And the out-of-pocket down payment was insanely low.
Yeah. 5% of $15,000 is really not that much money.
Yeah.
And if you amortize it over 30 years, it's not a huge deal. I always like to, we get in that situation sometimes where it's like, hey, we have a multiple counter. What should we do? And we'll take the time to change the TCA so that they can see, here's the real difference between 265 and 280 in terms of additional down payment and monthly payment. And it's it's $40 more a month. Are you willing to lose this house over $40 a month? That's less than $500 a year. And sometimes the answer is yes, and that's a good place to know. That's the cutoff. It's not worth it at that point. But a lot of times the answer is they're not willing to lose the house over $40 a month, and it's then make the higher offer. Let's go get it.
Yeah.
So but $15,000 as a percentage of 265, that seems like a lot of money, and $15,000 is a lot of money. Don't get me wrong; it's not couch change, but we just need to keep some perspective. And I think that's what that advisory role that I know that you do with your clients and I do with mine is really to take the time so they understand what those numbers really look like.
Perfect. So. Okay. And that really, I'm just going to say that helped seal the deal on a couple of buyers I had who really didn't want to come up, but they weren't willing to lose that house. And once you break down and show them that it's really $40-$50 every month, you can stop buying some Starbucks 3 days a week and make up that.
Break it down into lattes. Yeah, you can totally
break
it down into lattes. It's hey, that's 7 less lattes a month.
Yeah, so it's well worth it. So, okay, so my final question is, what do you do to just help your buyers determine which is the best loan for them? How do you know, we went over kind of the various different types of loan products and the, down payments and interest rates, but how do you make sure that they're really getting the best loan for themselves?
Yeah, for sure. So I think that's the advisory role. when they hone in on the specific property, like this is the house, we want this house, we do a TCA specifically for that house based off of the purchase price that they're making. We talk about the assets that they want to put towards that in terms of down payment. And then we do a side-by-side comparison, and we get on the phone or on a Zoom call and we go through it in detail so that they fully understand what they're doing. And then we talk about the pros and cons of that particular situation. And then we guide them down the path and help them make a decision on what's best financially. And that depends on their short-term, long-term goals, how long they're going to own the home, if there's a bunch of renovation that's going to be done. There are a number of factors that we really have to understand the strategy that they're going to use so that we can advise. So there is no way that a phone app or a push button solution is going to be able to give you advice. That's going to come from a person who listens, asks questions, and understands what your needs and desires are so that they can help guide you in that decision. So that's the whole thing. Is this is a personal one-on-one, let's have a conversation. I want to understand you. I want to listen and make sure that I understand what your goals are. And then we can give that advice. And then we can show you in numbers and graphs and charts and stuff how this is going to work for you. So that's where you move from being a mortgage loan originator to an advisor. And that's what we are.
And you guys, I think that's so important because anyone who is going to be taking a loan out, like Dan said, he's helping you get the largest debt of your life. And I refuse to work with buyers who are like, hey, I jumped on this app and it says I'm approved for this much. You're not approved. You just got a number. It doesn't mean you're actually approved, and things can always come up. And I am not willing to risk your time or my time going out and looking at properties based on something that your app said you might be approved for, and then risk getting your hopes like just completely crushed. So I know that you have to pick up the phone, you have to jump on some emails, and you have to dig through your files and pull out these documents, but it's so worth it in the end to just have it ready and be done and not risk getting your hopes up at the end of the day. Because like everyone keeps talking about we're going to have this mortgage or housing crisis, and they keep referencing like 2008. And there have been so many changes to the mortgage industry to prevent what happened in 2008. But if you take out a loan that you just can't pay for, you can't actually do, but somebody who's just a horrible business person and just not an ethical person was like, you got it, we can give you this loan, whatever, it's not good. And so you're going to end up losing the house anyways. So take the time to really qualify your team that you work with and do the steps that are necessary.
Absolutely. And a conversation that we have along the way is there's a difference between what I can approve you for and what you want to be qualified for. So I just had a call this morning with a client, and I said, tell me how this fits into your overall life. Like, what's your lifestyle like? Do you like to travel? Do you go out to expensive restaurants? Like, how do you spend your time and your assets and your resources? And we sorted out that, like, technically I could approve them for a $4,000 a month payment. That's what they would qualify for. But to fit their lifestyle, we needed their payment to be closer to $2,500. And that changes dramatically what their purchase price is. And there's houses that would work for their scenario, but I think a lot of other people would say, hey, here's the max you can go, here you can buy, see you later, but wouldn't take the time to say, like, well, how does this play into your overall goal? How is this, what's the payment target here? And then helping them make that decision. And that then drives what their real estate professional and realtor are showing them in terms of viable options for them to purchase. Does that make sense? So it's like, I can approve you for a much higher number a lot of times, but let's understand how this plays into your finances and like your overall lifestyle to make sure that you're not strapped every month worried about making a mortgage payment and you can't do the things that you really like to do in your life. So this is just one piece of your life. I mean, obviously with COVID and everything, it's a bigger piece of our life because our homes, our offices, they are our social place, like that's everything. It's so important right now, which I think is driving a lot of people's decision to buy. But obviously we need to make sure that it fits into your overall kind of life plan. So we have that conversation with our buyers too. Like, Tell us about your life. How does this play into your life? How long are you going to be there? What's important to you? And that will help guide the conversation and the buying decision that they make.
It's so important to get quality over just easy and whatever, because I've had some buyers who I'm working with right now, first time home buyers. They were approved for like a certain number. And then I did talk to them, like, do you really want to look at homes in that price range? Because I know you guys are a young family, you're kind of traveling, you're doing your thing. Like, what's your breakdown of your monthly payment going to be? Is that going to really still allow you to live the lifestyle that you and your family want to live? And they were like, you know what? Kind
There you
of
go.
like, let's go down a little bit. So that's why it's so important when you're picking your real estate team, whether it's your mortgage advisor or your real estate expert that you go with, that you're picking quality people over who's going to be easiest or who's going to tell you what you want to hear.
Sure. And we use all the technology to make things easy. We have a phone app that you can apply on and upload documents, and we do everything digitally, and we make the process easy. But technology to me is not the solution. It's a tool to help us be more efficient and to deliver faster results for our clients. So technology is nothing more than a tool. The most important thing is the relationship. Absolutely.
That's exactly right. Okay, Dan, thanks so much. Do you have any final words for potential buyers out there before we jump off?
Start early, see what's going on with your credit. I think that's a big driver right now. I see a lot of people disappointed because their credit score is not what they thought it was. Just because some online free credit report thing said that your credit score was one thing doesn't mean that that's true. So work with a professional, start the process early, and we are here to help you. So talk to someone that you trust, and let's help you buy a house.
And how can people get in touch with you?
You can email me or call me. My email address is dancheta@s1l.com, or you can find me on social media, Facebook, Instagram, wherever else, and kind of everywhere, LinkedIn. And my phone number is 707-490-5997. That's my cell phone number, so call me, text me. I'm always happy to help.
Awesome, you guys. Oh, Dan's got two little ones, so if he doesn't answer the phone right away, he's probably doing like bedtime, nap time, dinner.
That happens. Yeah. I have a 3-year-old and a 1-year-old, so I have my hands full.
But he'll get back to you.
With you, absolutely. Appreciate you.
Awesome, guys. Thanks so much
Thanks for
for
having me.
joining us. And if you're looking to buy a house, definitely check out Dan.